we look back over the last 11 years, the stock market, the financial markets have been, for the most part, in a pretty strong upward movement. In fact, just before this, we found that 9 of the last 11 years, counting this year, the markets have been positive. So just 2 negative years in the last 11. That's a good run. That's a good run. And some of those positive years were really quite positive. It's pretty strong years.
You're talking about, just set the frame here. So it's generally the S&P, the big companies in the U.S. that we're saying that market, that pool of companies, has been up 9 of the last 11 years.
Yeah.
You did some math here too, which says kind of annualized, like per year on an average. I don't know if you did 10 years back or something.
If we look over the last 10 years, the stock market's up over 13% on an annualized 10-year basis, 13.3. That's just the stock market, which of course diversified investors are going to own other things like bonds and perhaps some international companies, some smaller U.S. companies. Even a balanced portfolio, a balanced index is up 8.6% annualized over the last 10 years. Again, many strong years in there, and that includes owning bonds, like I said, other asset classes outside of the U.S. large segment.
Yeah, I think what is interesting here is that life's been good if you've been an investor. Maybe that's the big takeaway, and that there's been some down years. And I think that's partly what we want to talk about. And our last down year was in 2022.
Yeah.
That was the big one, or the most recent big one.
Yeah, and 2022 it goes down as being one of the worst years for not just a stock investor, but a diversified portfolio investor. Because that was the year we had bonds, the bond market was down about 13, the stock market was down about 18. So from a balanced portfolio perspective, it was a pretty big down year. So zooming in, just in the last few years, we see that we've had 2022 was a big down year, generally. 23, we saw some pretty good recovery. And then, of course, this year. So 23, the market was positive, up pretty sharp, both balanced portfolios as well as the stock market specifically. And then this year is another great example where the stock market this year has been performing quite strong as well.
Mm-hmm. Yeah, and we're just at the, top of...
3/4 of the way through.
Right. Yeah. So when we have those down years, there are things that we do, and when we have up years, there are things that we do as investment managers and people looking after portfolios.
Yeah, so let's talk through that. Let's talk about the down years first. We go through down year periods. There's oftentimes one of the most, what we find, or one effective kind of lever or tool we do is we'll do tax loss swapping, right? If there's investments that are held that have an unrealized capital loss, we can sell that, immediately transfer that, or sell it and buy a similar type of investment. Realize that capital loss for tax purposes, so it helps lower future tax bills, meanwhile maintaining a similar market exposure. And so it's a way to, in a down market, some of the silver linings, we can help create some tax efficiency going forward.
Mm-hmm. Mm-hmm. And I think we talked earlier that those can carry forward, right? That
Correct.
If the sort of losses realized in 2022, they're not just for 2022 necessarily.
Right, yeah, so a capital loss carry forward can be carried forward indefinitely.
Indefinitely? Until you use it up, I suppose.
Yeah,
right?
until you use it up, correct. Yep, and that's typically what happens, and that brings us to some of those upmarket years, right? I mentioned 22 was a down year, 23 was an up year, 24 has been an up year so far. And we get into up years, and you kind of get into these recovery periods, and oftentimes there's other types of actions we're taking, whether it's rebalancing, right? Assets that are moving in different directions at different times, they might get out of tolerance from what we have, from expectations. They might be ahead of expectations, for example. At which point we look to rebalance and trim them and rebalance and buy other types of investments in the portfolio.
Yeah, so if the market has done well in 2023 or 2024, you might sell some of that within a portfolio. And because you took losses, even though maybe you bought something similar or maybe rebalanced, again, it's individualized stuff here. But in 2022, you've carried that forward, and that the gains that you've made are then offset in some part by those losses that you realized.
Yeah. So just put some numbers behind it. Say, for example, a $50,000 loss was realized in 2022, And in 2023, or if you still had that $50,000 loss carry forward, you could offset approximately $50,000 of gains in that following year, and basically have a wash or net out.
Yeah, and maybe it's 25K in 1 year and 25K the next year, and you're kind of using up that buffer.
Yeah, exactly. Now, when you file your tax return, individual investors are able to take $3,000 a year loss carry forward at a time, offset that against ordinary income. But for the most part, we're just talking about capital gains and losses. And so you're right. So at some point, what we tend to see is that individuals will start to use up their tax loss carry forward, especially when you get through stronger market years like we've had for the last couple of years.
Yeah, if we're looking in back 11 years and 9 of them have been largely positive in the market, you're going to have more positive years than down years.
Yeah.
So it's almost like you take advantage of those down years when they come, but then this is where that tax intersection comes in. Is it on those up years, which are more frequent, looking historically, there's a tax bill.
Yeah, there can be. And if we reflect, or kind of narrow in again in the last 3 years, depending on individual circumstances, that may start to occur around this time, right? We've had a couple of really strong years. I think in terms of a retired couple that we're rebalancing, we're setting aside dollars for their income needs as the markets have moved higher, their portfolio has been performing well. And now it could be a scenario where we've used up all the tax loss carry forward, and maybe now there's a tax bill from capital gains, again, realized from rebalancing activity, maybe repositioning to other or different investments. But one of the takeaways of the point, though, is that throughout these different market cycles, ups and downs, there's going to be levers to pull in up and down markets. And especially in up markets, we want to make sure that we're prudently taking care and rebalancing when we can, looking for different opportunities when they present themselves, to make sure that the tax tail doesn't necessarily wag the dog effectively.
Yeah, we talk about the human emotions. It's not just numbers on a spreadsheet or in your portfolio. That human emotions are when we see the number going up and that portfolio balance, that number being higher, we feel pretty good, right? And we think it's going to be like this forever. Yeah, as we say.
Yeah, the tendency, it's human nature to think that where we are today is where we're always going to be. And that happens in the case of markets going down, right, where it can be really fatiguing to watch markets go down, and you're kind of wondering, when is it going to turn around? How long is this going to last? And the same is true on the flip side, right? These moments in time, these quarters and years where we have really strong performance. But it's still, as we always say, it's still important to take a prudent approach and make sure that we're measuring and adjusting for what we're asking the portfolio to do, what investors are asking the portfolio to do.
Yeah, so it's a bit of what is the market doing and what is that policy, or what do we need that money to do? Maybe it's individualized kind of tranches, or sort of, this is set aside for years 1, 2, and 3, in the case of a retired couple.
Right. Yeah, and we find too that spending pattern, it can and does change over time, right? Those spending needs, the needs that individuals have from their portfolios, they can and do change. And it may not always line up exactly with how the markets are performing, right? The years where you plan to spend more may not always be an up, strong market year. And we want to make sure that we defend against that, to make sure that before those years happen, that we're setting aside the dollars, taking away that risk from the short term, that potential volatility, so that we have the dollars available.
I feel like this conversation is largely around those who are kind of post-retirement, or largely living off of their portfolios and maybe Social Security and other investments. This makes a lot of sense for that scenario. Is there another scenario where you've got, you're still in accumulation phase? Does that change anything? Are the cues to take action any different? Yeah,
because you think in terms of portfolio and whether you're putting money in or taking money out, right? And for those retirees that we spend time on, they're generally taking money out. The flip side, though, are the accumulators, where they're generally adding, whether it's a 401k through their employer, or maybe they're just saving into a brokerage account. In those scenarios, by adding regularly, that's effectively a rebalancing mechanism. And so it's not uncommon, or one possible path is that rebalancing occurs over time as new money is put into that, from that earnings power, putting into their 401k, or whether it's going into a brokerage account. Part of that is automatic rebalancing that's occurring. And so in those scenarios, it's entirely possible that accumulators may have a different tax experience, a different because their rebalancing is different. Maybe still tax loss harvesting opportunities, but in terms of rebalancing with new monies coming in, it's another lever to pull that is different for an accumulator versus someone in the distribution phase.
Any other, I don't know exactly where I'm going with this, but other kind of tax considerations, like how do the taxes weigh on these decisions? Should they?
Yeah, taxes should, because it's taxes do weigh on decisions in terms of when's an appropriate time to rebalance, what's an appropriate amount to rebalance. A lot of it comes back to individual circumstances, what their risk tolerance is, and what they're asking their assets to do. But as an example, we think of different investments or assets in a portfolio all have a different job and a different level of expectations. And if we see a point in time where investments are ahead of expectations or even behind expectations, that might trigger a point in time when it's a good chance to rebalance. But we always want to keep in mind taxes for that, because at the end of the day, it comes down to what you keep, not necessarily what you make. And over time, we want to balance that tax implication with overall market growth and investment opportunities.
Yeah, and you talked about, what is that, or we said, here's the market average, right? A diversified portfolio, maybe it's 8.6, in a straight stock market, maybe it's around 13. So it seems like that there's an expectation. Again, we're certainly not making any future predictions here, but just looking back, that there's this sort of expectation, this lane that returns might be in over the long period. Again, this is a 10-year look back on average. So I guess I hear you saying if they're above those expectations, it's prudent to sell some.
Yeah, great example. And we have been above expectations. As we said, the stock market doing over 13% for the last 10 years, that's above expectations. The stock market tends to do about 10%. And so in that environment, we can and should expect that there's going to be more potential rebalancing occurring across a portfolio, more changes that may occur because the portfolio is going to get more and more out of tolerance from what the measured goals and the plan that we built together, that plan and what our ultimate investment policy is, that's going to deviate more when markets are up with a stronger overall return.
Some people maybe rebalance. Maybe that's the question.
How often should I rebalance?
How often should a person rebalance? Is it just market driven? Is it driven by goals? Is it driven by externalities?
Yeah, great question. A lot of times for us, it's heavily market driven, but also goals. Because as individuals change their spending over time, either taking out more or less, that's going to dictate how much they should have set aside for short-term living needs. And so because we always want to set that aside, it's entirely possible that their rebalance tolerance or threshold does change over time, but largely it's based on financial markets. And we've now, as you said, we've been through about 2 years worth of strong market up movements. And looking back at 2022, because we may have used up for a lot of investors, their tax loss carryforwards may have been consumed by other investment activity, portfolio management activity. And so one of the takeaways now is that these portfolio management activities, in our view, are very appropriate and prudent, especially as markets go up and down. And if we get to a point where the markets are going up strong, that's great. But it can also mean that there's potentially more capital gains realized. Again, it depends on different individuals, different circumstances. And we recognize that nobody really wants to sign up to pay more in taxes. But it's also an appropriate thing in terms of buy low, sell high, and making sure we're planning and investing for that long-term time horizon.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Be sure to consult first with a qualified financial advisor and/or a tax professional before implementing any investment strategy.